we'd like to move right along and introduce our next speaker, who I see has already signed on. The next session is called Developments in the Gold Industry. And speaking on that topic, very pleased to welcome Adrian Hammond, who is a senior analyst at SGB Securities. Adrian has been ranked a top 10 gold mining analyst since 2012 and has been rated the #1 gold mining analyst at least 6 times. Adrian joined SBG Securities in August of 2014. Before entering research, Adrian spent 3 years with Hatch as a process engineer focusing on the platinum industry. So, Adrian, if you'd like, we'll take you off of mute, and if you'd like to turn on your video. So, Adrian,
hi, David. Can you hear me?
Yes, sir, I can. Thank you so much. Great to have you with us. I'm not sure if you heard, but I just made the introduction for you, and we're ready for you. I gave you presenter mode so you can share your computer, and should be in good shape.
Thanks for that great introduction. I'm just trying to figure out how to share you on this new program. 1 second.
There's probably a button on the bottom of the screen that says share.
Got it. Don't know if you can see that.
Yes, we can. Sure, looks great.
Excellent. Yeah, so thanks to you, David, and your team for this opportunity to present to you today. As you already mentioned, I work for SBG Securities, which is a research house brokerage in South Africa. I'm based in Cape Town, but we have global offices. I look at not just gold, but also PGMs and oil and gas. And today I've been tasked to give you a bit of insight into this industry. I will give you some background, but I am no historian, so you'll have to excuse me. My focus really on equities, but I'll try my best just to paint this sort of picture. And I think it's really important in doing so to appreciate the view of where this industry could lead to, and certainly where prices could lead to. But before we start with that, I'd be happy to just give you a brief intro to who we are and what we do. SBG Securities is a wholly owned subsidiary of Standard Bank. You'll recognize that by the logo. And we, basically quite a broad-based bank assisting institutional and retail clients in research and trading across 17 markets in Africa, including the US and Europe. And we fortunately have the blessing of a top rating for some years now. We're quite a nimble team, 35 people covering 160 stocks, executing about 18% of the daily trades on the JSE. And that's the largest market share for any broker in South Africa. Offices are quite broadly spread out, but as you can see, focused in Africa and China. We do have a partnership with ICBC, which many of you are probably familiar with, Chinese-based bank, and they have a large commodities desk in London. And that helps us facilitate our South African client base with a broad offering on structured products, including ETFs and ETNs across all commodities, including agri commodities. Sorry, that was the slide I missed there. But I think let's kick off and hit the ground running with perhaps a bit of a history lesson as to where gold really started. Dating back to 3600 BC, gold was first mined in ancient Egypt and became very prevalent in the time of the pharaohs. What you're seeing here is the golden mask of Tutankhamun dating to 1223 BC. And gold during this time was mined generally for use in jewelry and items of worship. and it was going to be mined using very basic methods, as you can imagine, and that was largely in riverbeds. Moving on then to 600 BC, quite a time difference there. That was the first time gold was actually used in the form of coins, known as crucids, in a place called Lydia, which is otherwise known as Turkey today. And this soon became then the form of exchange. And I think I'd like to emphasize that in understanding that gold was a form of exchange all the way back then, and you need to appreciate that to assess how the price of gold could change or has been changing. And we'll talk a bit about that later. But it was only until 1717 the UK was set as the gold standard, which basically means that the gold price, or should I say the exchange, was pegged to the gold price, by which the government would then guarantee redemption. But today, of course, gold is in many important forms. Since dating back from the pharaohs, it became as prevalent today in use of both cultural and religious occasions, including bridal, particularly in the East. And why I mention this is because, well, half of all gold demand is jewelry based. But I'm afraid to say, as we'll discuss later, it has no relevance to the price, in my view at least. But we'll talk a bit about that later. So certainly gold has a real impact on humanity. And it was only till, let's say, the Industrial Revolution that gold really started to ramp up. And you're obviously quite familiar with the gold rush term, and certainly what has happened in the past in Colorado and California and Australia, and then soon after in South Africa. And really is interesting to understand that gold mining was the sort of birthplace for many cities today, both small and large, driving migration and economic growth. And you would probably, cast your mind back to the last trip you did on holiday. You would probably go into a small town, go into the museum, and you would often read the history of that town, which was its birthplace also began with gold mining. So gold is everywhere. In fact, it's even in the ocean at 1 part per trillion, in the crust 1 part per billion. But it's where the tectonic plates move with each other that creates the agglomeration of this very precious metal. And getting that out of the ground, of course, has presented its challenges. Certainly, with the advent of the Industrial Revolution, mining methods started to improve from the simple panning of gold in riverbeds, or otherwise known as alluvial mining, ramping that up to sluicing and hydraulic mining, which is still alluvial, but then progressing into more complex methods underground and mechanization, which was largely driven by the development of exploration techniques using seismics to identify ore bodies. And today, the next sort of leap, I would say, in modern mining techniques is not so much the mechanical methods, but the productivity enhancements through artificial intelligence. So even AI is making its way into what has been a common mining method for decades. So how's this played out in terms of the history of production? Our records only really go back until the 1850s, but really started only ramping up in the early 1900s, which is not really a long time ago if you think about time of the pharaohs. But we can identify 5 key cycles. And of course, one is going to constantly ask the question, has gold peaked? But we can appreciate what's happening in the last 120 odd years, with the first cycle being largely driven by growth in Southern Africa, which was discoveries in the late 1880s, 1890s. And that was then followed by the gold rush in Canada, the Klondike, which is the second big peak. And the third peak then was really where underground mining began in South Africa, which became the dominant producer in the world. In fact, all the gold ever mined today, half of that comes from South Africa. And of course, improvements in extraction and recoveries, particularly things like the stamp mill progressing to a ball mill, and obviously carbon and leach processes, which increased recoveries quite dramatically. But the fourth and fifth cycle, this is where the new gold's coming from. This is first the US growth there in Australia, but now more China and more from Africa, such as new jurisdictions like the Ivory Coast, and of course we're going more into the Middle East now. So the question is, where does this go? What is driving this? Certainly I've discussed that mining methods improve production and technology, but I think in the last two cycles really has been price. Gold companies tend to increase production with price, but so do costs. But the costs, you don't want to hear this, but like costs are rising. One of your questions you posed was what is happening to the intensity of costs? Well, unfortunately, all the good gold has been mined, and when I say that, I mean gold that is relatively on the surface. So beginning with early days rivers, now open pits, and then underground. So it was a bit of a combination of the good stuff's gone, and fewer people were willing to take the risk to explore for gold. And perhaps you're familiar with a company called Randgold, which then merged with Barrick to form a new company effectively. But Randgold was quite a standout company that really took those risks going into Africa and found new ore bodies. That is still the case, but now you'll find that companies are having to go further abroad, such as Saudi, such as Pakistan, places that yet are only opening up their borders now. But apart from that, gold is getting deeper, and what we call copper gold porphyry systems, which are, how do I explain this? Sort of think about a lava lamp underground, and you've got those blobs floating in that liquid that rises up with the shift in tectonic plates, creating these agglomerations of gold and copper. They're deep and they're expensive to mine, which is why no one mined them. And they're typically found around what you will see, it's called the Ring of Fire, or otherwise known as the Pacific Rim of Fire. And here you will find these deposits, but they are expensive to mine. But this is where mining has shifted. And you might have heard Barrick talk about shifting their production up in favor of copper. This is not because they want to really mine copper. In my view, I think it's because they had no choice. And so, yeah, I think that's where a lot of the new gold will need to come from. And of course, costs will continue to rise because of the depth. And so who's producing all of this gold? Well, as I mentioned, South Africa produced half of all the gold today, but they're down to 13th, 14th position from first, and being displaced by the likes of China, Russia, Australia, and Canada. And all those countries together form about 3/4 of all what you would call physical supply of gold. But a quarter of that is recycled, because gold is generally, I would say, easy of all commodities, quite easy to recycle. This just to illustrate, how much of gold is out there. You could fill 3 Olympic pools with all the gold ever mined today, and that gives you some perspective. It's not It's not a big amount, but in terms of value and liquidity, it will surprise you. We'll talk a bit about that later in terms of financial markets. But just let's go to the price now. So we talk about production, but what has the price done in the red then? As I mentioned, I think the gold standard in the UK is in the late sort of early 1700s. It was really only adopted in the 1870s internationally, with countries then using the gold to underwrite their currencies. But the World War II came around. The world was in a mess, and the Bretton Woods agreement was signed to rebuild the economic system, which brought 44 countries together and pegged their currencies to gold at $35 an ounce. This then, though, came to an end in 1971 when Nixon proposed an end to the agreement, decided the currencies should freely float and no longer be linked to gold, and effectively allowing to inflate the currency and print money. And the reason they couldn't keep the Bretton Woods agreement because there wasn't enough gold to underwrite that. But it was a shift, effectively, of a reserve currency going from the global reserve currency going from gold to dollars, and it was the dollar was chosen as the reserve currency because the US held 3/4 of all the gold, and I'm sure you're all familiar with Fort Knox. So and so, the picture quite clearly paints quite a substantial rise in the price, and we'll talk about how that price has played out and why. But to do that, I think we just need to clear something out the way, because we don't see gold as a commodity at all. You do have your demand in physical terms. Half of it's jewelry. Central banks buy it for as part of their reserves. You got bars and coins, and obviously a few bits and pieces in industrial use, but it's not a lot. And the supply chain to the demand side is quite complex for gold. From your Explorer on the left, this image courtesy of the World Gold Council, trying to paint the sort of the full picture of the lifespan of a gold ounce being collected from underground, ultimately being either fabricated into jewelry or into technology as a part, or ultimately into the financial system, into ETFs and central banks, etc. So in physical terms, as a commodity, if you think of gold as a commodity, it is not a lot by volume, but it is certainly large by value. Third in the world after oil and iron ore, or partly in line with iron ore. That oil valuation you see there in annual billions of dollars, there's a scale on the right-hand side of 2.4 trillion, with gold sitting at just under 400 billion. In financial world, gold is replicated in terms of its demand and supply many times. These are the sort of markets you'll find paper gold in, primarily over the counter and exchanges, with very little being accounted for ETFs. But if you compare the value of these secondary markets, gold is a substantially large asset class, just after the S&P, and as large as US T-bills. And so this is why we are so fascinated by this metal in many respects. But what does this mean? Well, certainly liquidity will certainly have an impact on gold as a price. But what does this mean in terms of price? Well, we know that supply-demand fundamentals have no application here. in terms of the traditional way of looking at supply and demand, which according to the World Gold Council has been in surplus for the last 10 years, yet the price keeps rising. So explain that. But, that's besides the point. I think, like most things though, the movement of the asset from one place to another is what's driving the price at the end of the day. And viewing it as a currency is critical, because if you think about all the gold produced since the beginning of time to the pharaohs still exists today, bar the few treasure chests at the bottom of the ocean. So viewing it as a currency is a lot more simple. And of course, trying to build a bull case for gold is even more simple. I'll tell you why. But here is money supply versus gold supply, very elementary since 2001. Money supply up sixfold, gold only up 40%. Now, if you think of gold as a currency denominated in dollars, and if you're supplying one more versus the other, certainly you would expect gold price to go up in this instance. And over time it has, as M2 money supply has increased since the Bretton Woods contract came to an end. So there's no surprise there. That's been well correlated for some time. Gold only really took off though in sort of 2000s. But we'll talk as to why that is. And I think it's interest rates really playing a part with the rates coming down. You've had this acceleration in the price too. So bear in mind, gold, if you see gold as a currency, it doesn't have a government. It can't set its own rate. It's denominated in dollars. So it doesn't have a mechanism in which it can be influenced itself, whereas the dollar can, through the Fed, through the money supply, and through the interest rate. And so I think this is what's confusing many of us today in trying to assess where we're going to go from here. Because in this instance, it's quite clear that money supply trumps any interest rate effect right now. And perhaps the behavior of gold of late is indicating that just recently when a more hawkish Fed suddenly, it created a knee-jerk reaction, but gold is held up quite significantly. And the bears out there for gold will tell you that gold should be at 14, 1600 or somewhere around there based on the real rate relationship. And that is true if you believe all the historical data of measuring correlations and all that are applied today. But I tell you what, I mean, the trend is your friend until it doesn't, until it's not. And I think we really need to break it down. And it's a bit more, my approach is a bit more elementary perhaps, but this chart here showing you the Fed rate in blue, gold in yellow, and real rates in gray. And an argument that real rates are if a real rate is negative, it's positive for gold, or if a real rate is positive, it's negative for gold. It's not. It's whether the rate, it's the second order. It's the rates of change that I think drives gold prices, and we can go back in time and see how gold actually has reacted in the dot-com bubble, during the GFC, and now recently in COVID. And there's been some clear changes in Fed policy, which has resulted in your change in the real rate that's driving the price. So if you break down that relationship, then you start to see the true sort of potential of where gold could be. And if you ignore all these colors and just say, well, gold has decoupled from its relationship, so we can ignore 22, 23, and 24. That's a bit naive, and it's easy to conclude that gold should be lower down the left-hand side of this curve rather than the right. But we are in a different regime. Money supply has doubled since COVID. Interest rates are high, but gold is very high. What's changed? And it's not that we are looking to the past in the right way. I think we need to look at what is the gold price telling you today, and it's telling you today that the money supplies had a larger influence than what the Fed rate can actually do for the currency. And I think if you consider where real rates are going by the Fed rate, then we're in for at least 3,000 by the end of this year, and 3,500 beyond next year, depending on your view, of course, of the interest rate. It's not I'm not going to stand here and tell you what the gold price is going to be. And I mean, big caveat here, no one should actually tell you what the gold price can be, because 90% of us are going to be wrong. But if this data or relationship holds, 200 bips on the Fed rate cut is going to send gold well north of 3.5. I just want to blow out of the water this view about central bank buying quickly, because it bothers me that is a driver of price. If I look at the purchases or movements in central bank buying, it's been pretty consistent for the last decade. There hasn't been anything very exceptional that I think is driving price. There has been obviously lots of Chinese buying of the metal, but it's not necessarily an exception. There's been quite a strong demand in China up until only recently on the jewelry side, but in my experience, jewelry demand and physical purchases, retail demand, does nothing for price other than perhaps create a floor for price when prices drop. Because particularly the in the Indian culture, gold demand rises when prices fall. And also, if you actually look at the rupee, also gives you a good indication of demand. So I hope that gives you a flavor of what gold is in terms of its history and development and production, and ultimately its behavior up until now. And perhaps I won't give up my day job yet, but I do think gold is destined for higher records. It really is just the trajectory right now for what the Fed does with rates. But ultimately, it's one which will come down, whether it's in the short term or long term, doesn't really matter. I personally hold the metal, and I think everyone should, as a form of diversification and insurance. The equities, unfortunately, a lot more complex, especially for those investors out there who are torn between short and long-term horizons. But take your pick. I mean, a lot of gold companies out there, explorers, small and large, they all produce the same metal, they all produce the same product, yet none of them actually meet their clients. You're producing a commodity that is sold directly to either refinery or to an exchange. It is even like a coal company or an iron ore company will have clients that have contracts and long-term contracts. Gold companies don't. And for that reason, I guess, makes it a bit more hard from a fundamental point of view in the management of these companies, because there's no stewardship coming from their customers. But perhaps the shareholders can drive some stewardship, but we'll talk about that just now. These are your major producers, Newmont being the largest, followed by Barrick, Agnico, AngloGold Ashanti. A lot of M&A has happened of late with Newmont and Newcrest combining, which has sort of put them into a position that is quite dominant. And I wouldn't be surprised if you see further M&A. Certainly, M&A is driven by the need to survive. And as I mentioned earlier, finding gold deposits is becoming harder. And one way companies try and remain relevant is through further M&A. But the irony is that you tend to do M&A when prices are high. You tend to overpay. That is the case, but not for all companies. There is still smart M&A, and I'll tell you why. It's the way these companies separate themselves from one another. And of course, you as an investor will want to identify which companies are doing what, because that ultimately is what drives ratings. You may not need to have a view on the gold price, but you can certainly trade one company against another based on the fundamentals. So, you've probably often heard the case, fundamental analysts are needed for gold companies if you think the gold price is going to go up, but you shouldn't think you're always right on the gold price, but you can be right on what we think companies are doing and what their outlook could be. But you need to assess what the DNA of a company is, and I think these are the sort of key ingredients that drive a company's rating. When I say rating, a company's the value of its paper. Asset quality, no doubt, obviously, cost position, the life of those assets, where they are, how complex they are, open pit or underground mining, management quality of them, do they give guidance, how transparent are they, what is the safety record like, capital allocation, ESG, all those wonderful things. This is what drives ratings, and this is the output. Any sort of price multiple, but typically EV/EBITDA is a good one because it shows you a sort of a more clean, fair approach to comparing companies. This is just the output. What you're seeing here is that Agnico trades on 9 times and Endeavour trades on 4 times. Why? Many reasons, for the ones that I just spoke of here. So why is this important? Well, I think if you're holding it for the long term, it certainly gives those companies in a more defensive than others. They tend to attract better credit ratings, lower cost of finance, better M&A potential. It's cheaper to buy a company on a lower rating if you're on a higher rating, all those obvious good things. It also brings shareholders to your register that you really want. Shareholders that will probably want to stick by you in the tough times. And that's quite key in managing these very complex businesses. So just to put money where my mouth is and try and substantiate what I've said, here is EV/EBITDA versus AISC. AISC stands for all-in sustaining cost. This is just a common definition used amongst the gold producers in standardizing their cost reporting. Quite a strong relationship there. And this is the current cost curve as of the end of third quarter 24 year to date. And, various reasons why companies have lower costs than others. It's open pit, underground, energy intensity, jurisdiction, and, I think makes it for an interesting investment space. If you have it's not a very steep cost curve, but it's steep enough for a space that allows, high conviction calls. So what drives a rating here would say, would a company move down this cost curve, or would it move up this cost curve over the next couple of years relative to peers? That is a strong reason to have a view on one company versus another. The life of the asset, very important. This is not a very strong relationship I'm showing you here, but it does give you some indication. The longer your life of the assets, certainly the higher the multiple, and certainly many more years of discounted cash flows. Safety, I did mention it briefly. Believe it or not, if you kill people, you will be punished. And this is quite evident in some of those companies you see on the right-hand side. But I think, generally speaking, these companies are well run, well managed, and unfortunately, some companies are just more exposed to higher, riskier geologies, such as deep level mining in South Africa. And that goes for actually anywhere in the world. Deep level mining is just really much more risky than open pit. Jurisdiction, yeah. So, if we're going to talk about countries and their investment attractiveness, according to the Fraser Institute, this is where they would rank them, with the US and Canada up there, followed by Australia, Europe, Africa, South America, Asia. Certainly now, of course, new jurisdictions are opening up. Some are closing down. You've heard the news in Mali. There's been lots of issues in Burkina Faso. These are certainly countries with more challenging political systems, and managing those. Some companies are better than others. I don't believe that all countries present the same risk. It's really how the relationship is managed. And a good example that if you go back in time and look at how Randgold managed to trade on the highest multiples ever in the sector for many, many years, and they only operated in Africa. But nevertheless, new jurisdictions are opening up, and be interesting to see how they flag, particularly Saudi Arabia. And it does drive ratings, believe it or not. So there you have it. Agnico Eagle right at the top, yeah, some few followers behind it, but not many. Ultimately, you are going to be rated by the investor community on your financials. I think it's fair to say that, and I think maybe worth talking about a company and as an example, like Harmony Gold. Harmony Gold, the company I cover and have been covering for way too long, has experienced a remarkable turnaround in its rating from about 3 times EV/EBITDA to 4.5. It's a purely South African producer, majority deep level underground mining. But this company was fortunate to have some good M&A, and it's just by that, I mean, it's very uncommon to see value accretive M&A, because you need to effectively justify to shareholders that you're not paying more than fair value, and why would anyone sell you for less than fair value? And you can create value through better operations, better productivity, synergies, etc. But in the case of Harmony, I think their acquisition of certain AngloGold assets was fortuitous for other reasons, but they managed to actually do a lot more with those assets. They've grown their production. They've increased their transparency. And what I mean by that is they've told the investor community, this is what we're going to do. This is what our production will be. This is what our costs will be. And they actually beat it. So maybe they undershot it a bit, but they did pretty well by increasing the number of years in which they did the forecasts. They gave more detail. And more importantly, in all of that, is that their safety record improved dramatically. And that was obviously from the top, being driven from the top. So don't underestimate the importance of these important ingredients to assessing your universe of companies out there. So do you buy the metal? Do you buy the equity? No. This is always a very difficult one to sort of answer. And I'm going to say, quite simply, in the long term, you buy the metal, and in the short term, you buy the equity. And your timing has to be very, very, very important, because unfortunately, over the long term, the gold companies tend to underperform. And unlike other commodities, we've spoken about gold as not a commodity, as an exchange rate. And I think the cost performance and behavior of these companies is one in which follows the price unusually. So as I mentioned before, gold price goes up. It tempts management to find gold that is probably more expensive. And we've heard the term so many times, quality over quantity. But I tell you what, generally miners want to produce at lower costs, and the only way you can do that is by increasing your volumes, because this is generally a fixed cost game. So costs tend to track price. Even the contractors working on your wage bill will renegotiate their contracts in a way that is indirectly linked to price, because as prices go up, there's certainly competition for contractors if you're growing, and they will bid up their prices. And this interesting curve here shows you the reserve gold price, and it'll be nice to see how these companies report at the upcoming reporting season and what their disclosure is around the reserves and what a reserve gold price is. A reserve gold price is basically the planning price. It's the company telling you at what level they wish to mine. And so if you increase your reserve gold price, it's either for two reasons. One is because your costs have gone up, and if you don't increase that price, you're going to mine less gold. Or two, you're going to mine more ounces that are of higher cost. So costs increase by design. And unfortunately, I think this is what's going to happen. And I think the market's also familiar with this, and you'll see it in the valuations a bit later. But wrapping up now, I mean, here's another example of capex over time. Certainly, I should show you the gold price here, but obviously ramped up during just post GFC, then came down again, and now it's ramping up again. And that, of course, squeezes the margins, and so companies tend to underperform over time. This is our recommendation and valuation to close, but for what it's worth, we like Anglo Gold. We think Gold Fields has some good upside, but I think there's still some risks there. Harmony is, obviously very risky, much more risky in terms of its leverage, but it's producing excellent free cash flows. But I think all of it is going to dig a new hole. So I don't see it's already appreciated quite substantially, but I think unless they change the div policy or something like that, do I see an outperformance. But on the bottom chart, you'll see, we look at what is price to NAV, really what I think the company is worth relative to where it's trading, and what you can see over time, moving from right to left, the price to NAV is contracting, and it's either telling you one of two things. One is the market doesn't think that the current price holds, and that it's going to go up, or they think these shares need to the shares need to adjust. So either the shares need to go up or the price needs to go up. One of the two needs to happen. But I think what it's really telling you is, generally during bull markets, price to NAVs do contract. There's a reticence there's a hesitancy to believe that gold prices will continue to rise. But yeah, that remains to be seen. So in the short term, I think you need to be a bit careful, but I generally like the sector, certainly over PGMs in the short term. But for the long term, you definitely want to keep buying the metal. And I think that's it.
Okay, thank you very much, Adrian. Very interesting presentation. You gave us a lot of historical context, explained how the industry dynamics work, talked about monetary policy and current gold companies. So thank you so much. It was excellent. If you have time, we do have a couple of questions.
Sure.
Okay. So, just as far as producing gold, do you want to tell us about any of the new technologies that are used? I understand that autonomous vehicles, are sometimes used deep in gold mines, for instance.
Yeah, like so mechanization is getting to the point. Look, um, the, you know, the background around mechanization is two things. One is it reduces your cost by taking larger volume, and two, keeps people out of from underground. And it's progressing to a point where you can remotely control vehicles autonomously from surface or even from another country. So you can have operators 24 hours a day. So you may have an operator during the day on site, and then at night in the other side of the world, someone else will take control of that machine. So it becomes, a non-stop operation, increasing your productivity there. But yeah, like in terms of actual technology, in terms of the extraction processing, there hasn't really been any major breakthroughs in recoveries. Recoveries are typically very high, around 95 to 97%. So you're really fighting for that 1 or 2 more percent, which is very difficult from a physical, chemical point of view. But in terms of underground mining, I think there's still lots of opportunities into terms of improving productivity, ultimately removing people from underground and improving safety. But yeah, at the end of the day, the ore body ultimately dictates the mining method. And unfortunately, some ore bodies are always going to be mined with people.
And maybe you can talk about the infrastructure in general in different mining countries. I understand sometimes electricity is a problem, not being able to rely on consistent electricity, even in South Africa.
Yeah,
Do you want to say anything about that?
yeah. Times have changed. I mean, during the early days of gold mining in South Africa, electricity was so cheap you didn't think about it in building a mine. There is no mine today that will be built without a full turnkey solution on your power supply, whether you are developing that yourself or in collaboration with the government. And it's typically going to be green energy. So, if possible, hydro is quite preferred, um, but otherwise it's going to be a combination of gas, diesel, and renewables. But no mine can fully rely on renewables, especially if you're doing high intensity, energy intensive processing. Renewables cannot provide you with the current and the voltage necessary for that. So, yeah, it's always a challenge. But at the end of the day, you're still going to need diesel for your trucks, especially open pits, and you're still going to need a constant source of electricity with sufficient current, um, that with preference off the main grid, but offset, of course, with renewables. And I dare say, though, those renewables will largely just be there for the carbon credits, not really to directly supply the power to the mine.
So I'm not sure if your answer was specific to South Africa as far as no one starting a new mine.
No, that was in general. In the case of South Africa, um, you know, Eskom hasn't had any load shedding for a year now, which is quite remarkable. It's a combination of factors that's improved the power supply issues in South Africa. Before, of course, there was a lot of throttling. What we were forced to ramp down supply or demand. But what's been happening, interestingly, and the combination of renewables being ramped up in South Africa has removed pressure off the system, combined, unfortunately, with a reduction in demand. And then third, improved maintenance of the existing coal-fired power stations in South Africa. Those three drivers is what resulted in basically quite a remarkable sudden end to load shedding. So I haven't heard in the last 12 months anything from any company or miner in South Africa about having to throttle their operations because of lack of power. But certainly new mines, new projects, I think are more difficult, as you need to secure that base load from Eskom. But I think there's no, I haven't heard of any projects being postponed or cancelled because of it.
Okay.
Don't know if that helps.
Yes, that is helpful. So another question is, a week or so ago, there was an article in the Wall Street Journal about countries that have gold mines becoming more aggressive in terms of renegotiating agreements with miners, seeking more equity or raising the permit fees or demanding more build out of infrastructure.
Yeah. It's unfortunate when gold prices run, people get greedy. And, that's the risk of operating in uncertain jurisdictions. You might have an agreement in place, you might have a mining license in place, but at the end of the day, it means nothing if the government suddenly changes it. But of course, it's really important for the miners to uphold their rights. Otherwise, it sets a bad precedent. So it'll be interesting to see the situation in Mali right now, because we have a company there that has a long-standing history in that country and significant experience throughout Africa, and that is a really it would be a really key milestone to see the sort of outcome there. But yeah, that's unfortunately the risk of some jurisdictions.
Okay. Do you want to talk about gold competing with crypto for investors' attention?
I think it's very separate things. I don't really compare gold to crypto, whether it's fashionable or not, of one versus the other. I don't buy that. The younger generation doesn't see gold as this safe haven or alternative investment asset class like crypto does, and that perhaps gold has underperformed crypto because of it. As I mentioned before, physical buying of gold doesn't move the price, and I don't think those who've been buying crypto are going to move the price for gold. Gold as an asset class is obviously very large in itself, and I see it still very much behaving like it should. The gold is behaving exactly where it should behave with respect to real rates and the movement of those real rates. So, yeah, I think at the end of the day, it's not your view should you buy gold or crypto. It's like, well, you're managing a portfolio and you want to be exposed to different asset classes. And I don't think the one versus the other is in the same category. I don't see, gold is like typically held as a form of insurance, and I don't see any asset manager out there taking crypto upon himself to in a serious form. They might lose a lot of clients.
Okay. And the last very quick question, what do you see happening with gold demand from new industries such as electric vehicles?
Marginal to insignificant.
Okay. Okay. Well, anyway, that brings us just about to the end of the hour. So this was an excellent presentation on the gold industry. We very much appreciate Adrian Hammond, who is a senior analyst at SGB Securities, for educating us on the history of gold, trends in gold, and investments in gold, and answering all of our questions. So, Adrian, thank you very much. We really appreciate it.
Thanks, David. Thanks for the opportunity.
You're welcome.